All right, good morning, ladies and gentlemen. Welcome to US CPI. And for those in the UK, of course, we have the time change in the US, and then we have the time change in the UK at the end of the month. So doing the stream at 12 p.m. UK time. But of course, for US traders, nothing changes for you as of yet. Now, US CPI, the last inflation report before we get the Fed rate decision next week on the 20th of March. Expected to more or less see figures remain unchanged compared to the priors, except the core data. CPI month on month is expected to see a tick up to 0.4%. But the core data is what a lot of investment banks and markets will be focusing on with this report here. So let's go through what it means first and how it affects the markets. Now, what is it? It represents how much consumers are paying for retail goods and services. And there are 26,000 retail outlets, 4,000 housing units in 87 urban areas where prices are collected on 80,000 goods and services. So the key measurements that make up the report, you have the housing, which represents about 42%, food and beverages, which represents about 14%, transportation 18%, and medical care about 8.5%. Then, of course, you have the core, which excludes the volatile parts of inflation, the food and energy, and then you get the core CPI data from that. Usually, when the market isn't so laser focused on inflation as much as the Federal Reserve is, when things are kind of normal in the economy and things are trudging along quite nicely, traders usually focus on the monthly change in inflation reports. They don't look at the inflation report as a whole. It's usually just the headline read of the CPI month to month that usually garners the most attention, because it's removing the effects of weather, production cycles, spending patterns that occur within the economy at a certain period of time. So usually the seasonally adjusted month-to-month figure gets the most attention. But of course, this is a different scenario. That's all being put to the side. The focus is on everything that's going on with inflation. So what's the difference between PCE and CPI? Key differences: PCE places a lower weight on prices of gasoline and residential rents, and focuses on the nation as a whole than just focusing on urban areas. Hello, yo yo yo. And CPI, the other thing with it is that CPI measures a fixed basket of goods for 2 years or so, whereas the PCE price index can kind of chop and change what it looks and measures at. So you get so the Federal Reserve gets a much better idea of spending habits or spending patterns within the US economy. Although the CPI is measuring the urban areas specifically, it's still the Fed's preferred gauge of measuring inflation in the nation as a whole. How does it affect the markets? So the dollar usually tends to strengthen when the economy is growing, and in this stance with inflation, if it is higher than expected, then you'd expect a stronger dollar to come out of it. One, because then traders will feel that the central bank will start to reprice that the central bank is going to continue to keep their rates where they are for longer, and also push out the likelihood of a June rate cut to maybe into July or maybe into August. Okay. But on the flip side, if you do get weaker than expected inflation, which is what the markets are looking for, right, today, they're looking for continued disinflation within the economy, particularly in the core data, then you would, in that case, see a more bearish reaction from the dollar instead. And you would see a positive reaction, or more a bullish reaction from the stock market instead. So the key thing for the stock market, stock indexes, is the underlying inflation data, or the core CPI data. So any sharp rises within a month can lead to stocks taking a hit. And of course, as said, the expectation is that CPI is supposedly supposed to continue the disinflation process and head down, not really expecting any bumps. But if those bumps do appear and they're stronger than not only the forecast figures, but also the prior figures, then there are issues, okay, with the inflation prospects and that the potential for inflation to then tick up again. And then what that also does is it pulls back in the scenario of the Federal Reserve, maybe at the very extreme end, leading to another rate hike in the future. But it would just be 1 month's worth of data. But it wouldn't be surprised if that were to occur, considering how the Federal Reserve has reacted to CPI data in the past. Okay, although CPI data in the past was much stronger where it is now, it's 3 times stronger, that still doesn't mean that from the past reactions, we have seen the Federal Reserve take stronger than expected actions with their rate decisions, or smaller than expected or weaker than expected actions with their rate decisions, and how they set monetary policy. So it's not a surprise if that does occur, if inflation is much stronger than the forecast and also the previous figure, and then you'd expect a more bearish reaction from the stock market and a more bullish reaction from the dollar. For bonds, same as the dollar, higher than expected reads will lead to higher yields and lower bond prices. And usually, when the economy is in a expansionary territory and things are trudging along nicely, usually what happens is naturally the market pulls out of the bond market and goes into the riskier assets, into the stock market. And then that leads to yields naturally rising. And of course, the government then steps in too and says, hey, here's some debt that we have, and we got a nice high yield on it, and it's got a good discount. You want to take it? One time opportunity that you got here. So then yields also rise from that too when the government sells their debt at their auctions. But in the short term, for what we need to focus on is that yields tend to go higher when inflation is higher, because of, in this scenario, that the central bank is either going to continue to keep rates where they are, or the possibility of them raising rates again. And of course, speculation from markets too about the Federal Reserve maybe being seen as not so dovish in the future as all markets previously would expect them to be. Okay, so the previous report then that we had in February, looking at the January report. So this is where the core month-to-month report showed the increases and decreases. Shelter, motor insurance, and medical care saw increases. Decreases were in used cars and apparel. And services in the last report was the strongest part of the inflation report as well. And that's what led to the rise led to the surprise in inflation. But it was also the beginning of the year as well. So there were some seasonal adjustments that weren't being factored in to the yearly figures that will hopefully, in the February report, according to some economists, it will start to calm down, hopefully, and not be as big or as hectic as it was for the last report. So that's also another thing to consider too. And hence you have traders that focus in normal periods on the monthly seasonally adjusted figure to get a better understanding of where spending is within the economy. The economy at the moment then, so NFP was at 275k compared to 229. Unemployment rate was at 3.9% compared to 3.7%. Average hourly earnings ticked down to 4.3% compared to 4.5%. Employment costs ticked down as well to 0.9% from 1.1%. The PCE price index year on year was at 2.4% compared to 2.6%. core PC price index down as well at 2.8% compared to 2.9%. ISM manufacturing prices paid was slightly lower, 52.5 compared to 52.9. Services prices paid was also lower, 58.6 compared to 64. I think somebody was talking about it in the chat. MM was saying services and manufacturing PMI and other data show it's most likely going to come down, but revisions will change the perspective potentially. Again, it'll be the services part of the inflation that's going to be key to keep an eye on. Of course, you're not going to see that as soon as the figure comes out. So that's going to take a bit of time to trudge through and then look at the report itself to see how strong or has services lost its momentum, or how much momentum has it lost, or has it completely reversed because of the new year, and that there are no seasonal adjustments for the yearly figures. Productivity, so services is going to be key to keep an eye on, but you can see that here prices paid by some services also ticking down as well. Productivity ticked down 3.2%, import prices going up to 0.8, export prices also going up to 0.8. PPI prices year on year ticking down 0.9%, and core PPI ticked up to 2% compared to 1.8%. Don't forget, that is going to be out this week too. We won't be covering the PPI. The market reaction is definitely not as big as the CPI release, but we will just keep an eye on it anyways, in general. So then let's look at the ranges and deviations. If you've seen the Google Sheets and you have access to the, if you're part of the MACROACE mailing list, thank you for subscribing, first of all, then you'll have access to the ranges and deviations. This shows you, we're looking at what the forecasts are, the high and low estimates. So you can see, according to economists, for the year on year, they have a high estimate of 3.2% and a low estimate of 2.9%, with a deviation of 0.1% on the high end and a 0.2% deviation on the low end. Core CPI with a high estimate of 3.8% and a low of 3.5%. So again, everything is more or less the same, except the CPI figures for the low end. Where they're expecting economists are expecting a slightly bigger deviation on the low end, because if they are expecting it to, if we look at the CPI figures for the year on year, they're expecting it to come to remain unchanged. For the core, they're expecting a decline. So if in those areas where you see that the core data is not seeing a decline and it's stickier, and I know White Eagle FX, you did ask a question. I haven't ignored it. As I was saying, so if you do get data that is stickier than expected, then you don't really have a clear direction. You're then just waiting for the market to kind of dictate what you should do, rather than, and if the market is confused, then your positioning is going to be a bit confused and it's going to be hectic. And we have seen in the past, and where you've seen me take a couple of trades for CPI, is that when the deviations are strong, that's when you get the most, you get better opportunities, because there's more volatility that is then present within the markets. So ideally, ourselves, right, if we want strong data, ideally, if the markets are expecting the inflation to go lower, I mean, this is for myself, so you do whatever you want to do, okay? I'd be looking for maybe a surprise in inflation going higher, because that's not what the market is expecting. They're looking for continued disinflation within the economy. If that doesn't happen, that would be a surprise, and then that will then create more volatility from that surprise. That's just my thinking of what everyone is expecting, of what to, just one of the things that I think. But it doesn't mean that if inflation is lower than expected, that's not also gonna create similar amount of volatility as well. It's just that remember, when the markets are surprised and then fear kicks in or the greed kicks in, then you have stronger movements that can occur within the markets, and then from that, more opportunities are then created. So, is everyone all good with that over there? Oof. Can we go back to 2021 CPI reports? Yeah. You can only wish, but I don't think Americans would want to live with that kind of inflation, and neither anyone in the UK or Europe. All right. Yeah, let's go. So sentiment and views then. Let's carry on. Ooh. So sentiment and views. So Bank of America, the 11th of March, they said the print should confirm inflation is on a downward trend, but services inflation remains sticky. CBA, they say that overseas CPI in the US will garner the most attention, and they expect another solid rise of 0.4% for the on the month-to-month figure, and for the headline, and 0.3% for the core inflation figure. Citi, they say that while headline inflation is expected to be sticky, core inflation is expected to decelerate in February for the month-to-month. For the year-on-year, for the year-on-year core data, a downside surprise would have more implications than an upside surprise, as the Fed will be cutting rates regardless. They say that US financial institutions and equities should prepare to rally on soft core CPI data, again, according to Citi. Goldman Sachs, they say the markets will clearly be looking for further evidence that January effect is behind us. Again, remember the volatility of the beginning of the year and the seasonal adjustments that are not present in the year-on-year figures for that. They say that they expect softer inflation needs to follow mixed employment reports from the NFP report, which should allow for some further downside, and the dollar depreciation is attributed to better growth news abroad. So the overall weakness in the dollar has performed so far, but you also have not only with growth news, you also have how the Bank of Japan have been viewed as more hawkish. So the yen has been gaining a lot of strength, and the Federal Reserve is going into the easing phase, or is about to go into the easing phase quite soon. That leads to the weakness in the dollar. And of course, you had the mixed report too from non-farm payrolls. So things are kind of changing towards dollar decline. And then that makes the likelihood, well, if that makes it the scenario that if data is stronger than expected for CPI, then that would then provide a boost up to the dollar and probably reverse its downside movement that it's been experiencing for quite a bit now. HSBC, they say that service sector inflation is proving much stickier than goods, making the path to 2% target a potentially bumpy one. So this is something that we need to be aware of with Fed commentary too. I don't think I've seen any Fed members saying they're expecting a bumpy ride, that they are seeing disinflation within the economy, but they're being data dependent. So if they start to, I know they have said in the past before, they have said it last year. So if they say they expect more bumpy rides again, then of course the logic is you'd expect inflation reports that are also going to see ups and downs, and then make it a bit more confusing for the Federal Reserve, or a bit harder, not confusing, a bit harder for when the Federal Reserve starts to cut rates, or by how much do they cut rates within this year. So if that rhetoric creeps in again of Fed members saying they could see a bumpy road or might experience a bumpy road with the disinflation process, that could be something just to be aware of, besides the report, right? Of course, you're not going to be able to use that for the CPI report itself, but just when we think about some of the fundamental bits of news that could come through. Just need to be aware of the rhetoric. What's currently being said, what's not being said, what was said and is being brought up again. Does that make sense? MM says, bumpy ride, more degenerate trades on my terminal. Oh no. The maximum is in the articles that we have for the day ahead, or the morning juice. You should be able to see that there. Okay, yeah. Yeah. We do everything. But yes, let us know if there's something that we don't do. But if it is something that we're doing but haven't done yet, and you say, hey, what's going on? Well, just let us know anyway, and we'll see if we can try and accommodate and make the service better. All right, let's carry on. So Fed and government views. Fed's Logan, we've got about 9 minutes. Logan said, whoops, let me just bring up. So, whoa, let's bring up here. Oops. It's just yeah. So with Fed's Logan. So with Fed's Logan, they said that on March 1st that in this environment, moving slowly can reduce the risk of an accident that would require us to stop soon. Also talking about the need with a QT2, saying that we need to disconnect the idea of slower run-off pace and ending QT. And the outlook for inflation is to be sustained near target. Labour market loosening is still robust. And then with Fed's barking, saying that we'll see if there are rate cuts this year, considering how the current summary of economic projections from the Federal Reserve is looking at 3 rate cuts, or in total 75 basis points in total for the year. He also says that he still sees wage and inflation pressures, which is going to be quite key for, I mean, we've already had the wage data last week, with it coming in at 4.3%, so a slight moderation there. And then with Fed's Collins, with Fed Collins, that they said that the threat of inflation remaining above 2% has reduced, and that there needs to be more evidence that disinflationary process will continue before starting to carefully normalize policy. And a couple more things with Fed's Powell that they are waiting. Fed's Powell says that we are waiting to be more confident, and we are not far from it when in regards to being in the right place with monetary policy. So that's also going to be quite, that's a key confidence thing, is how confident is the Federal Reserve with their monetary policy where it is at the moment. If there is hesitation still that they're not confident with the disinflation process, then you're looking for harder days, basically, i.e. rates are going to stay higher for longer. And he also said on March 6th that as we go forward, 12-month inflation will continue to drop, and that he's not looking for better inflation readings than we've had. He's looking for more of what we have seen. So again, just to clarify, we're not looking for inflation to go all the way down to 2%, but we do need more evidence. And at the moment, it depends on how these reports go. If it's choppy, I mean, the January report, yes, was a little bit of a surprise, but not totally unexpected, considering the seasonal adjustments and the non-seasonally adjusted data for the year-on-year data. So that's again something that's not a surprise, but for the Fed to feel more confident, if we do get a decline in these figures here for today, that should help cement the Fed's goal. I think what we have, yeah. So we'll have a couple more inflation prints before the next before the June meeting. Sorry, 4 more inflation prints, including this one. Before we get the expected rate cut in June, or that could go further out. Okay, so that's all done. Market pricing, we're going to go through here. Fed futures still looking at 64% for the first rate cut in June. February 16th, traders of short-term interest rate futures add to bets Fed may defer first rate cut until after June. 21st, short-term interest rate futures add to earlier losses after the release of the January FMC. And then interest rate futures start to decrease as Fed's wallet states no urgency to reduce rates. So remember, when Fed fund futures decrease, you just got to calculate the difference between the price. So you do 100 minus what the price is, and then you get the rate differential, and then that's what the bet expectation is of what Fed funds futures are looking at. So if it decreases, then it means that it's going to be higher. But if the figure increases, like 99.9, that means there is more easing to be expected. Short-term rates futures rise after jobs report. Traders still see June start Fed rate cuts after jobs report, with a 30% chance of starting May 1st. So that's new, or we're going backwards to within our pricing of when to expect rate cuts from the Federal Reserve. So that'll be interesting to see how much that firms up if inflation continues to go down, and also surprise the markets and isn't in line with expectation. If it is in line with expectations, then the direction of where the Fed might go, whether it be in, let's say, May or June, becomes more difficult. So stronger than expected data, June is a more likely scenario, maybe even into July. Weaker than expected data, June will probably still be the scenario, but the likelihood of May then also picks up if the data is much weaker than expected. Okay. All right. So we got about 3 minutes. So this is the last release here. We've got about 3 minutes to the release. So here we go. This was about 10 seconds before the last release. I did take a trade off screen, and then a couple of trades were on screen as well. But the data was, you can see, was stronger than expected overall. The race about 1%. And then if we, where we go, kind of skip to there. You probably see it appear. I don't think well, or at least show it. Yeah, so a shoulder in the NQ. Waited for a little bit of a pullback before I jumped in. And then what I realized, and then what I checked was how big the reaction was on the NQ. And that was mighty big. So let's kind of skip forward. We've got 2 minutes left. You can see that the market reaction kind of held. It was a strong bit of data. Let's get out of this here. Let's go to deviations. We've got 1 minute left now. Okay, 1 minute. But dollar yen usually has the strongest market reaction out of the data for CPI. So yes, let's have a little look. Let's get TICKSTRIKE up and running. Okay. Where are we? Okay, I'm going to go quiet in a bit now. So oh, so data was stronger than expected, but looks like it might not do well here. It's pulled back quite a bit from that. So the only figure that was in line with expectation was the CPI month to month. But we'll also keep an eye on what TICKSTRIKE is doing too. See how that plays out. All right. Okay. All right, that didn't work. Fair enough. It did whip more, so, but I was expecting if data was stronger than expected, that it might have gone down. Anyway, so that didn't pan out there. So we'll leave that then. We won't take any more trades in that case. We'll see what the futures are doing too. See if there's anything short-term interest rates. Fewer short-term interest rate futures drop after inflation data. You did also have OPEC too, but that's not going to affect the market here. What else? Yeah, there's nothing else. All right, so yeah, as said, CPI headline CPI was stronger than expected, 3.2%. Also stronger than the prior. Month to month is also stronger than the prior too, but as expected, year on year at 3.8%. This is strange. Okay. Now I've got to do a little bit of digging. So into the report itself, that's the only thing that's going to have to, that's going to make it clear as to why it went back. Right, there we go. That's the, let's see, ZT. Let's go. It's had a little bit of whip too. All right. Okay, let's have a look at this together then. Let's get TICKSTRIKE out of the way. Services. No, there's a bit of a decline in the month-on-month. Rise in transportation for the month-on-month. Services is still the, what looks to be, it's still providing the biggest movement here within the report. Okay, well that's a bit of a strange reaction. I was expecting further downside movement from that, but hey. Now let's just see what else there is. Nope. Yeah. Okay. I'm not seeing anything in here. That's kind of convincing me why there was a bit of a whip as of yet. Maybe you guys would have seen something that I haven't seen. Hmm. Mm. That would help. Let's try to see if there's anything else in the newsfeed. What do we got? So gas sources is down. Energy sources is also down as well. Okay, so it may be that from part of the report where you have services down in the month-to-month figures, like in energy services or not utilities, or services. Where was that? Yeah, services less energy. Like these small minor declines here that we can see. Medical services too. Although they're not that big, that's the only thing that I can think of as to why the markets could react that way. Because if the data is stronger than expected, then that shouldn't really happen. But it's happened. So there's got to be something else in the report that I am not seeing. Or it could be the fact that that the rise in inflation isn't that much. Just simply isn't. And the core CPI data, although higher than the forecast, is still lower than the prior figure. So, and the core data is something that the investment banks are looking at. But still, it's, yeah, that's me pulling at strings there, really. And maybe those strings are enough for what traders have done there. But anyway, okay. So, yeah, loss in a trade there. Oh well. Next time. Anyways, that concludes MACROACE for the week. And next week, as I said, we've got the Fed interest rate decision. We have the Bank of England interest rate decision as well, which is the following day as well. And then, but we will be covering both of those. So now, one thing I didn't kind of get to show you guys in detail was the CPI report. Oh yeah, no, I'm over it now. Yeah, don't worry about it. After this stream is done, I'm just gonna sit underneath my table and just cry, rocking backwards and forwards. Go. Nah. Yeah, you win some, you lose some. That's right, Gav. You got caught and short burned as well. Annoying day. Yeah. Okay, so again, if you liked the video and you enjoyed it, then don't forget to subscribe to the channel, give the video a like, share the video as well with your fellow friends and traders, get the word out there about MACROACE with the information. Now, this is where the meat of the information is provided, or what is going to be the most useful for you guys as day traders to understand how the markets, what the markets are doing. This shows you how the markets react to economic releases. Okay, depending on the size of the deviation and also what the release is that is being covered. So you can see here when you had data, even if you see, look, even when there was no deviation, you can see here that it represents how big the movement was. This initial market reaction here, this figure, okay, shows you the initial market reaction going to the wick of the candle, okay? And then the figure in the black brackets shows you the movement 10 minutes after the release going to the end of the candle, where the candle ended. And then this figure in the blue brackets shows you the movement 30 minutes after the market reaction has occurred. So what this shows you is a nice breakdown in a simple way as to how much the markets have reacted to economic releases over a set period of time that we measure them on. So you can see here in the past where data has been higher than expected, and when all data was higher than expected, you had a nice strong reaction. Even when you might have had a couple of points that were stronger than even if you had one bit of data that was in line with expectation, you still had a decent market reaction there. Anyways, so CPI isn't the only release that is covered. You can see that there are variations of different economic releases that are covered as well, that are put here. So I said we got PPI this week. That also we will monitor to see how well that to see how that does, and then obviously listed down here in live and real time. Some of the releases might not have any updated figures, like ADP, simply because the economic release hasn't really had that much of caused that much of a market reaction. Recently, there hasn't been that much of a market reaction from ADP, so it's been kind of silent. Central banks rate decisions will always be covered with those. With the Bank of Canada, with the Bank of England and the ECB rate decision, those will always be covered in live streams, and you can see not only how much the markets have reacted to the rate decision. The key thing is the sentiment and what was said in the rate statement that led to that market reaction. Because of course, with rate statements, rate decisions, there's a rate statement that comes along with it too that you have to read through and then make up your own decision. Sometimes you might be a bit too late. Sometimes it's super nice and easy, and there's an easy way to tell, okay, the central bank's being more hawkish or dovish in the country. Hence, I put this in the sentiment of what was said last time, so then it's easier for you to understand what's either going to be new or different from the last rate decision. And of course, I go through it in the live stream anyways before the rate statement happens in a bit more detail. Okay, so that's the MACROACE main list. I don't know if you hopefully you guys are using it so far, or whoever's subscribed to the MACROACE main list and you've got access to the ranges and deviations, you guys have used it and you found it useful. Is that true? Is my statement true? Have you guys found the deviations Google Sheet useful? Whilst I've got you guys here. Pradmal Kumar. Oh, you signed up a couple of weeks before. Send me an email to tony@financialjuice.com, and I'll have a little check. Yeah, just send me an email there, and I'll have a check, see if you did subscribe or not. But for those who do subscribe today to the MACROACE main list, I've put in the chat there the link. Then you'll get access to the MACROACE main list. You get access to the Google deviations sheet on Monday morning when I send out my week ahead email. I always send out one email a week for the week ahead. I sent out this week's one a bit late into the US session. There's some new formatting stuff that I was trying, but it's once a week that an email is sent out to you guys. So this is how the email will look. Okay, just so to kind of temper expectations. Let me bring this up here. Here we go. There. Okay. Can't I? There we are. So it's simple. It's giving you a little bit of a rundown of what to expect in Asia, the Europe, and the US session. Summary of some of the weekend news. You have a link to the ranges and deviations and the live streams. And then also what would be covered. This is last week's. This is a while ago. This email here, but this is how it usually looks. It's simple. There's not a lot of detail there. Okay, a couple of bits of expectations from investment banks that are put in there as well for you to have a look at, but not a lot of info because I go through that in the live stream with you guys. Okay. and it's just better to do it that way. Keep the information simple and as a refresher for the week ahead, then explain it to you guys in a live stream like this. So if you guys have found that useful, then definitely let me know in the chat or in the email that I've an email to me. If you do have any recommendations, then let me know of what we can do to make it better. But yeah, so if you subscribe today to the MACROACE mailing list, you'll get the email on Monday, usually before the US session begins. But as I said, this week I was a bit late. Okay, so that's MACROACE mailing list. Let's get out of that here. FinancialJuice. So FinancialJuice, where we said where we get the data from. So if you can see here that we have FinancialJuice. If you're unaware of who we are, what we do, it is a live voice and text service, keeping you up to date with what's going on within the markets and the global economy too. All in one place via voice and text. Okay. So here on the right hand side, we have our live voice feed here. So you would have heard James, I believe, reading the economic release. Who one of our guys on the mic, and in the center you have the text news feed here of the text headlines of what's been said on the microphone being put out as text. Okay, also in the center you have the need to know market risk, keeping you up to date with the headlines that could affect the markets or have already affected the markets. On the left hand side here you have your economic calendar as well, of the upcoming economic releases for the week ahead, and that's all in live and real time as well. Key thing is, I'll go over there again, FinancialJuice provides you live, real-time financial news all in one place via voice and text, okay, on our news platform here. Now, we currently have an interesting, or we have a great offer for everyone at the moment. We have our March Madness offer, okay, where you can get FJ for $99 a year for a year, rather than paying $1,100 for a year's worth for a subscription. Okay, so that's $99 with a 92% discount, rather than paying $1,100 for the year, with the March Madness discount here, which is a link I'll provide in the chat if it lets me do it. Here we go. There we go. March Madness. Put that in here. There we go. So that's the promo code March Madness. Now, first of all, before you decide to subscribe to FinancialJuice or make a payment, if you decide to, make sure that you have a FinancialJuice account, okay? And that will take you to the light version of FinancialJuice, which I've just put the link there. I'll pin the promo there for you at the top. But the last link I've just posted is the link to FinancialJuice. Make an account first, which will be a free account, and that's the light version of FinancialJuice. That has a delay and to across the site for voice, text, and the economic releases. But once you've made your account and you've verified your account via your email, then when you feel ready that you want to subscribe to the pro version of FinancialJuice to get the live real-time version of the news, then go ahead and do that. But make sure you have your login details and everything verified. Once you've paid your subscription, log out of FinancialJuice and then log back in, and then you should get the pro version of FinancialJuice and what I see here. If it's in the top left hand corner, it should say, well, you kind of see where I'm clicking, it should say FinancialJuice Pro, okay, if you're pro, and it won't say delayed on the streaming cog there, okay, it should just say Pro, and that's how you know you've got Pro. But yeah, as I said, March Madness, the promo code to get FJ for $99 a year rather than paying $1,100 a year. So 92% discount, all for you guys to jump on to that there. TICKSTRIKE. Yes. Somebody said, what is TICKSTRIKE? So with the mock data, yeah. So the mock data, it's the final mock data that is garnering the most attention. So yeah, it's that's from feedback, from the use of it, from what we've had, from what people have said, and also the data that we're using too is also a bit more restricted now as well on our side. So the final mock is what I know. It's been done in a certain way for years, but it is just the figure at 10 to the hour that will be posted instead. So it's just down to the data that we have access to and what traders have been mentioning to us over the period of time with the use of it. Okay. Yeah. So with TICKSTRIKE, so let me just bring that back up. TICKSTRIKE, what it allows you to do, is it shows you how strong the buying or selling momentum is within a certain asset. Let me just close that off. There we go. Get rid of that there. So yeah, as said, it shows you the strength of the buying or selling momentum within the certain asset, whether that be in forex, crypto, stocks, futures, with your internals or your ETFs or ETNs. That's what TICKSTRIKE gives you the access and the ability to do, is to be able to see how strong the buying or selling momentum is. So let's say we're looking at the dollar yen. Okay, this is called the ticker box, is what I've just dragged up here. Okay, the ticker box shows you the strength of the buying and selling momentum, and it goes from 1 all the way to 15. 1 is the most sensitive to market reactions. So when there's a little bit of buying or selling going on, then TICKSTRIKE will, as you can see, give you a visual and audio alert. Okay, and you can choose between either visual or audio, or if you can do both, whatever works for you. So 1 is the most sensitive. Then you drag it up all the way to 15. 15 is the least sensitive to market reactions. So only when there's a lot of buying or selling momentum that is occurring will TICKSTRIKE give you a visual or audio alert, or both. Okay, and you can see here that other kind of markets are slowing down a little bit. You can see that the momentum isn't that strong as what it probably would have been at the little peak, at the peak that was created. So we can do, this is the nice thing about TICKSTRIKE, is you can select what kind of sensitivity that you want, how much strength that you're looking for within that asset or assets before you make your decision. So this tool is made for day traders. Okay, there you go. You've got dollar yen. There's some buy momentum, and it's going to 10. So that looks to be, quite strong. Some buying momentum for that time. Okay, where the market, how the market usually trades at the time. Then the other feature about TICKSTRIKE 2 is this lightning bolt feature. So if you like to scalp the markets, right, for those little opportunities here and there. Okay, you ready? See how crazy TICKSTRIKE goes. So if you think that 1 was most sensitive, with the lightning bolt, TICKSTRIKE goes 15 levels below 1, and then you get this. Can you see that? Because there's I'm not sure about where you check for your pro date or where that expires. I guess it's yeah, I'm not sure. I'm sure, but it would be from your receipt then that you would have got. for when you sign up. The live stream, but this is YouTube. So MACROACE is separate from FinancialJuice. That it's not part of FinancialJuice Pro. It's for everyone. So hence there is a bit of a delay. Also, it wouldn't be smart to have a delay to put it in real time anyway. There's always a bit of a delay on YouTube live streams with the streams. And it wouldn't be smart just to give away FinancialJuice Pro on YouTube. That would not be good business, would it? But yeah, so it's made for everyone. It's not just Pro members. But yeah, as you can see here, TICKSTRIKE going off crazy with the lightning bolt. So again, if you, as I said, 15 levels below 1, so it's uber sensitive to market reactions. So if you really like those, taking those small little opportunities, it's crazy for me. So I can't deal with it. But you know, if you like that kind of, if you like that kind of trading, if you scalp the markets for those opportunities, go ahead, be my guest. You have that tool there now to be able to look at and utilize and make part of your trading. Now, if you're not sure as to whether TICKSTRIKE is useful for you or not, don't forget on the FinancialJuice homepage or the newsfeed, you do have the restricted version, i.e. it's set to a certain strength level, which I think is 6, and you can only look at the S&P, Eurodollar, oil, and Bitcoin, nothing else. Okay, so you can't chop or change it, but it will give you an idea as to how to utilize TICKSTRIKE, right? And then when you're ready to make your decision as to whether you want to go to the Pro version or not, then I think I already put the link in the chat. Have I? Ooh. No, I don't think I have. I'll put it in again. Yeah, there we go. Da-da-da. That's linked to TICKSTRIKE there for you. Call, that's something we can answer later on if you send an email to us at support of FinancialJuice. Yeah, so support at FinancialJuice.com. There you go. That's the link to. Did I do probably? Yeah, I did. Okay. Yeah, that concludes the live stream then for CPI. Don't forget to give the video a like, share the channel, subscribe to the channel, get the word out there, share the video as well. And I will see you guys next week, Wednesday and also Thursday. Wednesday for FMC and Thursday for the Bank of England. But for now, have a lovely rest of day, and I'll see you guys then. Okay, take care.